The Jared Dillian Show.
I'm Jared Dillian. This is the Jared Dillian Show. If you want to call to talk about your money, please call 844-305-7800. That's 844-305-7800. This is the Jared Dillian Show. Tonight we're going to talk about insurance. We have a guest, my friend Chuck Hinners. Chuck is a veteran life insurance agent with over 45 years of experience. His customers are primarily self-employed entrepreneurs and professionals in nearly every state. He is the author of Insider Trading in the Life Insurance Market, which he published in 2015. He joins us today from his office in Louisville, Kentucky. Chuck, welcome to the show.
Thank you, Jared. Great to be with you.
Yeah. So that's the short version of your background. Give us a little, you've spent a long career in insurance. Just tell us a little bit more about where you've been and what you've done.
Well, like a lot of people, I thought college was a good value back in 1965. So I got a business degree from University of Wisconsin in Madison, majoring in finance and real estate. Then Vietnam was going on, and so I, rather than get drafted, I enlisted, spent a couple of years in the Army, came back and finished up law school, which I had actually started. So I have a law degree as well. But that wasn't for me. I practiced law for a year and decided, my dad told me when I was 12, he said, "You're not going to be a good employee, kid. You better find something you can do." He was self-employed. I've been self-employed now for basically my whole career. And it was the right move for me because if I went in another direction, I probably wouldn't be talking to you. I'd have been long gone.
Tell us a little bit about your book.
Okay, Insider Trading in the Life Insurance Market, and it's kind of a grabby title. I've had people reject it when I sent it to them because it had the magic words insider trading on, so it went into their spam filter, and I've actually had the regulators look at it and say, "How can you be talking about insider trading?" And you're laughing because you've been in the securities industry for a long time, and that's having to put up with compliance. It makes everything more expensive for consumers, and that's been my long-standing opinion. But the reason I wrote the book is because of the lack of disclosure that people put up with and often don't know about the commissions that are getting paid to life insurance agents when they buy a life insurance policy. There are different kinds of life insurance available out there. There's more now than there were in 1974 when I came in the business. Back then, it was simply term and whole life, and there wasn't much else in between. And then in 1976, variable life started to make a little run. And so you could invest in the stock market, but as you might suspect, the commissions were still undisclosed. The fees for managing the funds that the premium dollars got put into had high management costs, and so those kind of products generally weren't very well accepted. And then in 1980, they invented something called universal life, which was essentially buy term and invest the difference in this side fund, and the insurance company managed it all. And it was significant because then interest rates were in nearly 20%. There was actually an insurance company in 1980 that was selling life insurance that projected a 21% interest rate for the life of the policy, and the numbers got ridiculous, and after 20 years, they got up in the millions of dollars, starting with a couple $100,000 of insurance. So that stuff was actually a lot of it was sold. It replaced traditional stuff like whole life that had been in force for a long time. And the interest rates on all these products were pushing 10% then, and that's a far cry from what we see today. Today, the better mutual companies are paying between 5 and 6%, And rather than 50 or 60 mutual companies, there's about 5 or 6 that are still left. So we have a smaller marketplace to choose from. There's fewer life insurance companies. The ones that have survived have gotten huge. They're run by bureaucracies, and bureaucracies have to get paid, and the consumer suffered. So I wrote this book back in 2015 and essentially lifted the hood to show people how their insurance policies work, and that's the subject of the book. And people, of course, they can buy that on Amazon. I think you've had a couple copies that I've sent to you over the years to answer different questions. And so that's how we got a little history there, how we got from 1974 to 2021.
Very good. We're talking to Chuck Hinners, who is a veteran life insurance agent. Let's start with the basics. Now, you talked about term, you talked about whole life, you talked about universal life, but educate the people listening, educate me, because I'm certainly not an expert on stuff. What is term, whole life, and universal life?
Okay, term insurance, you're basically paying a number that's based on the probability that you will die in that year. So if you're 35 years old, that's a low probability, and you might be able to buy $1 million of life insurance for $400 or $500. Now, the premium can be one of two structures. It used to be everything would go up every year. That was called annual renewable term. Companies started getting competitive on that, and so what would happen, Company A would write a policy, and the next year Company B might have a lower price, even with an older age, and so Company B would come in and replace that. It took about 5 years for the insurance companies to say, there's got to be a better solution. So they started doing level terms. So it was a guaranteed premium for a period of time that was that the buyer wanted to have a guarantee for, and that's generally 10, 20, or 30 years. Those policies still exist in the market. Whole life, on the other end of the spectrum, you paid a premium, and the money was taken out mostly in the first year, mostly commissions, never disclosed, and people would pay $10,000 maybe for $1 million whole life policy. They'd look at the cash value and there'd be nothing at the end of the first year, and that's because the commission could be 99% of the premium, which leaves $100 left over, and that gets spent by the home office. And so the company has to keep these policies in force a couple of years before they can even begin to have a profit on them. And if the life insurance companies don't make a profit, they don't last, and then people buy insurance, and the company's gone, and that's not a good situation to be in, and that's happened a few times. But the states, which regulate life insurance, have a pretty good system of the fallback. So if a company gets in trouble, it can be taken over by state regulators, and their books of business can be sent to other companies which agree to take care of this. Now, with all the debt we're taking on now, I question, is that going to prevent bankruptcies? I think the answer is no. I think we're going to see weaker insurance companies go bankrupt, and so it's incumbent upon people to, when they're buying insurance, to find out about the rating, and if the premium looks too good to be true, it probably is, and there's a reason for it. And then finally, universal life is as I said before, it competes with whole life. It's permanent life insurance, but the insured has complete flexibility in how much they pay into it, so long as it's enough to cover the probability that they'll die in that year. In other words, the yearly renewable term premium. And so they can buy and replicate a term policy, which is actually a deal that people aren't aware that they can take advantage of, and it's a better deal. Now, you're a derivatives trader, and you know about options and the Black-Scholes model and pricing, and that actually enters into how the premiums are set for term insurance that has a conversion option. And all that means is you can start out, pay an annual premium that's in the hundreds of dollars. If you convert it, it's now in the thousands of dollars. but you're building up a reserve, and the cash value you can, because your cost of insurance in the early years is lower, a whole life policy, you're overpaying for term, and the extra money is going into the reserve in the policy. Now, in the first year, not much of that goes in with a traditional whole life policy. I told you that 99% can go out in commission. But with a properly structured policy, that commission, whether it's whole life or universal life, can be deeply discounted. Rather than 99% on a whole life policy, perhaps we can reduce it to as low as 15 or 20%. On a universal life policy, with one mutual carrier, we can reduce it all the way to 3%. And then buyers need to understand that there's actually companies out there that will sell them life insurance that doesn't pay a commission. And you might ask me, well, Hinners, how do you get paid if you write those for your clients? How do you get paid? And, we simply, being a lawyer, I'm probably pretty good at charging fees and calculating what my time is worth. And actually, from my standpoint, that might be a better solution, particularly for higher net worth clients, which is kind of who we serve in our practice. We have business referred to us from all over the country and literally have clients in all 50 states. So,
hey, Chuck, hold that thought. Hold that thought. We gotta jump to a break. We're going to be back in a couple of seconds with Chuck Hinners, who is our expert on life insurance. I'm Jared Dillian. This is The Jared Dillian Show.
The Jared Dillian Show.